Mohamed El-Erian, welcome to The Business.
Thank you for having me.
Mohamed, global central banks have exhausted almost all of their ammunition. Rates pretty much everywhere are near zero. Have central banks lost control of interest rates?
So central banks have exhausted most of their interest rate policy flexibility. And we can have an interesting discussion. Did they do it too early? Did they do it too late? How did they do it? But basically, they've exhausted that tool. What they have not exhausted are focused interventions to relieve market stress, to reduce the probability of market malfunction, which would then reduce the probability of finance reverse contaminating a real economy that's already under stress with the coronavirus. So there's one part of the arsenal that's empty. There's another part that can be used in a very selective and targeted manner.
Here in Australia, the RBA is looking likely to cut the official cash rate down to 0.25% tomorrow and begin quantitative easing. Is that the right move?
So I've been quite critical of the Federal Reserve cutting rates. In the United States, they cut rates by 150 basis points in a week. And the reason why I was critical is because it wasn't accompanied by more laser-like measures. And I want to put that in the context of what you will see in Australia. Cutting rates at this point is like pushing on a string. If you can refinance your mortgage at a lower rate, if you can get a loan at a lower rate, you will not travel, you will not engage in the whole range of economic activity, because it's not a question of ability, it's a question of willingness. And interest rate changes do not impact our willingness to engage. What they do is help our balance sheet, and that's wonderful, but it's important to understand what interest rates can and cannot do. And in the case of the United States, there was a question as to, do you really want to use all your ammunition right now? QE, quantitative easing, has a different goal. It liquefies markets and in particular helps areas of market stress, and that's important. But I think equally important is for other central banks to follow what the Bank of England did and to follow what the Fed did, which is look at areas where there's market malfunction risk and try and address that. And we've had a host of measures recently in the US. A little bit late, but at least we're getting them done now.
We're facing a serious liquidity crisis here. Credit markets are seizing up. How bad is it?
It's bad. It's bad because the last thing we want is a liquidity problem to become a solvency problem. We are having a massive economic sudden stop. It's the sort of thing that happens in fragile and failed states. It's the sort of thing that happens in a community that's hit hard by natural disaster. It doesn't happen economy-wide, and it certainly doesn't happen worldwide. But that's what's occurring right now. When you're hit with an economic sudden stop, if you have financing to do, it becomes very difficult. So suddenly you'd have no cash flow coming in, you have your costs going up, and at the same time, if you have maturing debt, your balance sheet becomes a problem. So what you can find that a liquidity problem can become a solvency problem. Solvency problems mean unemployment, means deeper recession, and means more permanent scar to the global economy. So it's very important to do whatever we can to minimize the risk of a liquidity problem becoming a solvency problem.
How did we get here?
So the immediate cause of this was, of course, the coronavirus. And I've been warning for almost 2 months now, don't underestimate cascading economic stops. It starts by some place in the world, it starts small, and then if the underlying cause is not addressed, these sudden stops will cascade, and next thing you know, you reach critical mass. And I think we reached critical mass over the weekend. And what is critical mass? It is a massive simultaneous destructions of both supply and demand. People look at the airline industry and say, oh, that's an extreme. Actually, it's not. It's the leading indicator of what many small businesses are now feeling, and almost every sector in the economy is feeling. And it works something like this. Demand collapses. We don't want to travel anymore. We're worried about travel, or we are told not to travel by our governments. What do airlines do? They do what's natural, which is they cut their operating capacity. They cut flights. They put staff on some sort of unpaid leave, or they even lay off people, and they certainly don't use as many part-time people. They stop paying suppliers because they don't need as many supplies. And the demand shock becomes a supply shock. A demand destruction becomes a supply destruction, which then destroys someone else's income and destroys someone else's demand. And that cycle of simultaneous self-feeding demand and supply destruction is now happening in more and more sectors. That was the trigger. And it is something, as I said earlier, that's unprecedented for big modern economies, let alone the whole world. But the initial conditions were also problematic. You know, one always says, if you want to know where you're going to get to, you better know your starting point. And our starting point was years of insufficient growth, both in terms of magnitude and how inclusive it was, years of artificial support for asset prices, and years where we put way too much reliance on central banks and did not address the underlying causes of productivity. And when you have these conditions, this fragility, and you give it a major shock, like a human being who is fragile, has existing conditions, and then they get a major illness, it makes the recovery harder. And that's why I push back so hard against this notion that it will be a V-like economic recovery. It may be in financial markets, but for the global economy, not only are we going into a deep recession, it will look more like a U than it does like a V, and we're going to come out with a changed landscape.
How do we work our way through this? How do you address the unique issue that is both a supply and a demand crisis?
So there are three very distinct phases. The first one is the emergency response. And that starts with health, starts with medical advances to give you and me confidence that the virus can be contained, that can be treated, and that immunity can be increased. A vaccine, of course, does all that, but that's going to take some time. But tremendous focus on healthcare, and then a second very important focus on protecting the most vulnerable segments of our society and protecting the most strategic sectors of our economy, so that we don't do damage, even more damage, and that we protect the vulnerable. That is phase one, and that is critical. Phase two, when the economics of fear, which augment all this, start to stabilize, you then deploy the general fiscal and monetary measures that, in addition to helping balance sheets, which are being helped in phase one already, also start slowly reactivating economic activity. Phase three is, once you recover, deal with the consequences of this major shock. You know, we are going to start thinking differently as a society in terms of how we operate. Companies are going to start thinking very differently about just efficiency, cost effectiveness, and just-in-time inventory. All that was globalization, was supply chains all over the world. Now they're going to think about resilience, insurance. So we're going to have to make sure that we don't overreact as a society to this massive shock.
How do you see this pandemic playing out for all asset classes? For example, here in Australia, house prices have been jumping significantly in recent years. Should homeowners be preparing for a housing crash?
So conditions differ, but we have to understand whether you're in housing, whether you are in other segments, and I can tell you high yield bonds being another one as an asset class, that you have benefited from an extraordinary period of liquidity injection. It's not normal. And it's true not only for sectors, it's true for markets as a whole. I tell people investors have been living the dream. And what do I mean by living the dream? Look at 2019. Three things happened that should not happen together, and for good reason, but they did. And they lulled the marketplace into a sense of complacency. First, you made massive returns in holding risky assets. If you held a passive index of the US market, for example, you made 30%. That's a great return for a year in which we had the trade war, sluggish growth, Europe flirting with recession, and the list goes on. You also made money in your risk-free assets, the ones that you hold as an insurance. You're not supposed to make money then. You're supposed to pay an insurance premium. But guess what? You made money on government bonds as well. And you managed to do all that in the context of virtually no volatility. That should not happen. That is the background, and it tells you how artificial the financial world had become and how decoupled it was from the underlying reality. Now, I think we are going to reprice a lot of sectors. So if I'm a homeowner, there's certain things I would do and certain things I would not do. I would certainly refinance my mortgage if I can. I would benefit from this reaction by central banks to get to zero interest rate as quickly as they can. I would not go out and lever my balance sheet by taking on an enormous mortgage for a house that's really expensive, because you've got to be careful that you don't get whacked by not only the housing market coming down because the demand for housing is less, but also your income being hit because we are facing a global recession.
Initially, Donald Trump seemed to be fairly relaxed about COVID-19. That appears to have changed now. How significant is government leadership here to, I guess, calm the community psyche?
Critical, absolutely critical. Because without government leadership, you get market failures. You get all of us self-insuring. If you don't trust the government in tackling a crisis, you will self-insure. And you've already seen this behavior in the United States. Shelves are empty. Not just hand sanitizers, paper towel, they're virtually empty across the board. And you don't want this sort of behavior, this panicky behavior, making things worse. Because if you see me worry, you're going to start worrying. Even if you don't want to start worrying yourself, you're going to have to protect your family in terms of getting some supplies, because otherwise I'll take them all. So, it's really important. And we are finally seeing progress in 4 ways that I'm really encouraged by. One, the all-in-government approach. And this is really important. It has taken time, but it's happening. 2, we're seeing more private-public partnerships. 3, we're seeing within the private sector companies getting together and trying to address issues. We've seen it in pharmaceutical. Scientists are collaborating in ways we haven't seen for a long time. We're seeing it within the banks. We're seeing it in big tech. And finally, we're seeing a growing example of individual companies putting social responsibility and their community ahead of their short-term profits. And I think that can reach a critical mass that will help us navigate better what's ahead. It's not going to stop us from going into a global recession, but it will help us navigate what is otherwise a really difficult journey.
Once this crisis is all over, will the global economy be forever changed?
Yes, we are going to revisit the globalization of supply and demand chains, not because they're a good thing, but because they're not resilient enough to the world we live in. We're going to think twice about certain travel. We're going to weaponize, unfortunately, an increasing number of economic and investment tools. So we will come out of this, but we'll come out different. On the other side, the plus side, we would have lived through a crisis, and when you live through a crisis prevention becomes more of a focus. We would hopefully have held together as an international community, because this is a collective problem that needs collective responsibility and collective action. And companies would have operated differently. And I think we as a society are holding up our companies to higher standards. We want them to be more socially responsible. The environment, we want them to be more socially, their footprint in community. So I think there'll be good and bad things, but it will be very different from how we were going into this.
Mohamed El-Erian, good to talk to you on The Business.
Thank you.